Warren Buffett, the Oracle of Omaha. The name itself just brings up images of, smart investments, huge wealth.
Yeah, absolutely.
But today, we're not just, looking at the final score. We want to dive deep into the playbook itself.
Right.
Really dissect the core competitive advantages that, fueled his legendary success, both in the companies he backed and his own way of doing business.
Exactly. It's really not about lucky breaks, is it? Buffett's career is, well, it's a fascinating study in how you identify and cultivate and then leverage these distinct edges. In finance, in business, we're going to try and trace how these advantages evolved, from his very earliest stuff right up to the behemoth that is Berkshire Hathaway today.
So think of this as our deep dive into the strategies behind Buffett's wins. We've looked at his investment philosophies, his famous idea of economic moats, even things like his communication style and, his relentless learning.
Yeah, the reading habit is legendary.
It is. So our mission here, to give you a kind of shortcut to understanding some really fundamental principles, things you can apply whether you're managing a portfolio or, building a business from scratch.
And hopefully some insights that might actually surprise you. Definitely some takeaways you can use without all the dense Wall Street jargon you usually get.
Okay, so let's start way back. Back in Omaha, Warren's earliest ventures, they were small, sure, but incredibly telling.
Yeah, you have to think beyond just like selling gum or delivering newspapers.
Right. These weren't just kids making pocket money. These early hustles selling magazines, placing those pinball machines, they're like a training ground for some really basic advantages.
What jumps out at me is just that early entrepreneurial drive. He wasn't just earning, he was actively looking for opportunities and figuring out how to make money from them. And just as important, I think, you see the beginnings of incredible financial discipline that focus on saving, understanding the basic math of it all, even as a really young kid.
And you saw the results, didn't you? By the time he got to college, he'd already saved up a pretty significant amount, maybe, $90,000 in today's money?
Something like that, yeah. Plus, he learned some crucial lessons early on, like the pain of selling winning stocks too soon. That was a mistake he definitely learned from.
You bet he did.
Precisely. And he wasn't just making money, he was putting it back to work. Reinvesting profits from his pinball route to buy more machines, that's a perfect example of understanding compounding returns really early.
Yeah.
Even stuff like filing his own taxes as a teenager, buying that farmland young. It just shows a level of financial thinking, a long-term view that was, pretty unusual.
It's interesting to think about who his competitors were back then. It wasn't big companies, obviously.
Right.
It was like other kids selling stuff. Or maybe just the temptation to spend the money instead of saving or reinvesting it, or even just taking a regular job instead of doing his own thing.
Which brings up a good point for anyone listening who's maybe starting their own thing. What can you really take away from those early days? Right. Well, it seems pretty clear there's huge value in just starting early, learning by doing, and developing that financial discipline, saving, reinvesting profits strategically to grow more. Those are, foundational principles, right? They still apply no matter how big you get.
Okay, moving forward, a really pivotal moment. Warren Buffett actively seeks out Benjamin Graham, ends up working for him.
Huge, yeah.
This mentorship, this grounding in value investing, it became like a core competitive edge for him.
Absolutely undeniable. Graham was, the intellectual father of value investing, the whole idea of buying stocks for way less than they're actually worth.
The intrinsic value idea.
Exactly. And Buffett didn't just read Graham's books. He went and worked right alongside him. That direct hands-on learning from the master, that was an incredible advantage.
And it really shaped how he invested, didn't it? He got good at finding what Graham called those net stocks.
Companies basically trading for less than their breakup value, their liquidation value.
Right. He learned to focus purely on the business fundamentals and pretty much ignore all the market's crazy ups and downs.
The benefits from that intense mentorship are just so clear. He got this deep, practical grasp of Graham's methods, which led directly to some very successful early investments. He developed this systematic, rigorous way of analyzing businesses based on what they were truly worth.
And he applied it with real focus. He wasn't chasing trends or market sentiment. He was digging into financial statements, looking for those hidden bargains.
Yeah.
And he also developed that crucial investor trait, patience.
Yeah.
Just being able to hold on, even when the market freaked out.
Which is fascinating when you think about what others were doing then. So many investors were caught up in like speculation, chasing quick profits, or buying into these new theories about efficient markets.
Areas Buffett basically said to ignore.
Pretty much, yeah. Even back then, he was skeptical.
So for an entrepreneur listening now, what's the takeaway from that Graham period?
We'll actively look for mentors, right? People with deep, proven experience in what you do. Really try to understand the fundamental value of your own business, your market dynamics. And maybe the biggest thing, learn to tune out the short-term noise. Focus on the core strengths, the long-term potential of what you're actually building.
Then he goes back to Omaha, starts his own investment partnership. And this is where things really start to compound, both the money and his reputation.
Precisely. He took those Graham principles and just ran with them very successfully. What's really interesting here, though, is how he dealt with his investors. He really fostered this sense of partnership. Transparency was key. He treated their money like it was his own.
Yeah, three big advantages seem to pop out from that time. One, the consistent returns, obviously making his partners and himself wealthy.
It's crucial.
Two, his growing ability to attract more investors, more capital. And three, the beginnings of that whole Oracle of Omaha reputation starting to form.
And they all fed each other, didn't they? The great results built the track record built trust, the trust let him manage more money, which allowed for bigger bets.
And he put it into practice by concentrating his bets, right? Investing heavily in a few businesses he really understood.
Yeah, acting like a business owner, not just a stock picker or speculator, making significant, impactful investments based on that deep understanding.
His competition then, other investment partnerships, maybe early mutual funds, everyone dealing with the same market ups and downs.
And probably still some skepticism from the mainstream finance world looking at his concentrated value approach as maybe too different, too risky.
So for entrepreneurs who are trying to scale up, build relationships with investors or partners, what are the lessons from those partnership years?
Well, consistently deliver results. That's the bedrock of trust and reputation, isn't it?
Yeah.
Treat your investors, your partners, like real collaborators. Communicate openly, share the vision, and always, always keep that long-term view. Focus on building sustainable value, not just quick wins.
Now, the Berkshire Hathaway acquisition, that's a really key and maybe slightly unexpected part of the story. It starts as this failing textile mill.
Right.
And Buffett strategically turns it into this massive investment vehicle. It really shows his adaptability and also the discipline to, well, change direction completely.
It really does. The early Berkshire was nothing like it is now. It was in a terrible industry. But Buffett saw it differently. He saw it as a holding company, a platform to redeploy capital.
So the competitive advantage there was his strategic insight, to pivot away from that dying business.
That, combined with the discipline to say no to trying to fix the unfixable textile business, and also saying no to investments that didn't meet his strict criteria as he evolved.
And the benefits were huge. He freed up capital, stuck in a bad business, created the foundation for much better investments later. He didn't fall into that trap of pouring good money after bad, trying to save something fundamentally broken.
Yeah, he recognized the need for a radical change, and he implemented it by first using the small cash flow from textiles to buy other things.
Right, funding other investments.
While systematically winding down the textile side and applying increasingly tough standards for any new acquisitions.
His competitors then were, other textile companies fighting the same decline, businesses he might have invested that capital in instead. Maybe even some internal resistance at Berkshire to letting go of textiles.
All plausible, yeah.
So for entrepreneurs maybe facing tough choices about their own business direction, the Berkshire story has some real lessons, right?
Absolutely. Be willing to make those hard calls. Cut your losses, exit things that aren't working, focus your resources where the real potential is, and don't be afraid to fundamentally change your business model if you have to.
Then comes this really significant evolution in his thinking. And Charlie Munger's influence here is huge.
Yeah.
The shift towards investing in companies with durable economic moats. This idea becomes just central to his long-term success.
Yes, exactly. This was a move away from just finding cheap stocks, the cigar butts Graham talked about, towards finding truly great companies.
Companies that could defend themselves.
Right. Companies with these enduring competitive advantages, moats that protect their profits and market share for the long haul. Think of it like a castle moat keeping invaders out.
Strong brands, cost advantages.
Network effects, switching costs, all examples of moats.
And the signs of this new competitive edge are clear. a much bigger focus on finding these sustainable advantages, really digging into what makes a moat strong and taking a super long-term view on whether that advantage will last.
And the payoff has been massive, hasn't it? Investing in companies that generate high, consistent returns for decades, protection against competitors chipping away at their business, and actually lower overall risk because these businesses are just so strong and resilient.
You see it in the big long-term holdings like Coca-Cola, Apple more recently, these candies.
Classic moat businesses.
He applied it by really dissecting business models, looking for those defenses, looking at metrics like consistently high returns on capital, strong margins, lots of free cash flow. Those were the signs.
His competitors here weren't necessarily other investors doing the exact same thing, maybe. It was more those who just didn't get the importance of these durable advantages or who were just focused on short-term trading.
Right.
Plus, any actual company trying to compete directly with a Coke or an Apple, they faced a huge uphill battle because of those moats.
So for an entrepreneur trying to build a business that lasts, what's the core lesson here?
Focus like a laser on building your own durable competitive advantage, your economic moat. Define clearly what makes your offering hard to copy. Understand the different kinds of moats, brand, cost, network, etc., and strategically build and reinforce the ones that fit your business.
Okay, as Berkshire got bigger and bigger, Buffett's own reputation, his integrity, his unique way of buying companies, that itself became a huge competitive advantage, especially for attracting sellers of large private businesses.
Exactly right. At a certain point, many owners of great private companies actually preferred selling to Berkshire, not always just for the top dollar either.
Why was that?
It was about trust. They trusted Buffett, they knew Berkshire would be a permanent home for their company, and crucially, he promised to mostly leave their management teams in place to keep running things. That decades-long reputation for fairness, for keeping his word, that was golden.
So the signs of that advantage. Berkshire started getting looks at great deals, sometimes without even a bidding war, just because sellers wanted him.
Yeah, his reputation preceded him. And offering that management autonomy, that long-term commitment, that was incredibly appealing to founders who'd built their life's work.
The benefits? Well, access to high-quality companies maybe others couldn't buy, smoother deals because everyone trusted each other, and just continuing to strengthen Berkshire with these great businesses.
He put it into practice by buying whole businesses, not just stock positions, by keeping the successful management teams, and just by consistently doing what he said he'd do year after year.
His competitors in those deals were often, what, private equity firms?
Often, yeah. Firms known for perhaps heavy restructuring, maybe quick flips, loading up debt.
Or investment bankers pushing different kinds of deals that maybe didn't suit the seller's long-term goals.
Exactly. Buffett offered something different, something more permanent and hands-off.
So takeaways for entrepreneurs, even if you're not selling a billion-dollar company.
Build that rock-solid reputation for integrity in everything you do. Understand what really matters to your partners, your team, maybe future acquirers, and offer value beyond just the money. Being consistent and ethical over the long run. That creates this incredibly powerful, lasting edge.
Okay, finally, let's talk about what I think of as the compounding power of his disciplines, his learning, his emotional control, his patience, and his communication style. This seems like the enduring edge that supports everything else.
I think that's spot on. His voracious reading habit, that lifelong learning,
Spends hours a day reading, right?
still does, apparently. That plus his incredible emotional control, his patience in investing, and his clear, simple, transparent communication, especially in those annual letters. These aren't just like personality quirks. They are fundamental competitive advantages in a world that's often irrational and noisy.
You see it in how much he reads, how calm he stays during market crashes, and how he can explain really complex financial ideas so simply, treating shareholders like partners.
Yeah, like intelligent partners.
Right. The benefits are huge, aren't they?
Yeah.
Continuous learning means better decisions. Emotional discipline stops you from making stupid, fear-based mistakes. And that clear communication builds deep trust and loyalty.
He applies it by, well, actually dedicating huge chunks of his time to reading and thinking, by sticking to his principles even when everyone else is panicking or chasing fads, and by writing those incredibly candid, insightful annual letters that honestly are must-reads for anyone in business or finance.
His competitors here. Maybe impatient investors who can't control their emotions.
Definitely. Business leaders who are terrible communicators or aren't transparent, anyone just constantly reacting to short-term market swings instead of focusing on the long game.
So as we wrap up this deep dive into all these different facets of Buffett's competitive edge,
Hmm.
what are the big final lessons for our listeners?
Well, I'd say prioritize continuous learning. Stay curious. Cultivate that patience, that emotional discipline in how you make decisions, and really strive to communicate clearly, honestly, transparently with everyone, your team, your partners, your customers. Treat them with respect, like valued partners.
Okay, so to leave you with a final thought to mull over,
Yeah.
what are the core economic moats you're actively building around your own work, your own ventures? And how can you cultivate those same kinds of enduring disciplines, the learning, the patience, the clear communication that have really defined Buffett's incredible career? Think about the specific practical lessons from his journey that you can maybe start applying in your own life.
It really is about building that foundation for lasting success, isn't it? Sort of one strategic brick at a time.
Thanks for taking this deep dive with us. Warren Buffett, the Oracle of Omaha. The name itself just brings up images of, smart investments, huge wealth.
Yeah, absolutely.
But today, we're not just looking at the final score. We want to dive deep into the playbook itself,
Right.
really dissect the core competitive advantages that, well, fueled his legendary success, both in the companies he backed and his own way of doing business.
Exactly. It's really not about lucky breaks, is it? Buffett's career is, well, it's a fascinating study in how you identify and cultivate and then leverage these distinct edges. In finance, in business, we're going to try and trace how these advantages evolved, from his very earliest stuff right up to the behemoth that is Berkshire Hathaway today.
So think of this as our deep dive into the strategies behind Buffett's wins. We've looked at his investment philosophies, his famous idea of economic moats, even things like his communication style and, well, his relentless learning.
Yeah, the reading habit is legendary.
It is. So our mission here, to give you a kind of shortcut to understanding some really fundamental principles, things you can apply whether you're managing a portfolio or, building a business from scratch.
And hopefully some insights that might actually surprise you. Definitely some takeaways you can use without all the dense Wall Street jargon you usually get.
Okay, so let's start way back. Back in Omaha,